The most dangerous investor is not the reckless one, it is the brilliant one, certain he has finally solved the game that has humbled every generation before him. History does not punish ignorance most severely, it reserves its harshest lessons for genius, the moment genius confuses its models with reality. In 1998, the most decorated minds in modern finance built a machine they believed was perfect. Markets disagreed, and the world nearly paid the price. This is the story of long-term capital management, a fund so powerful, so leveraged, so certain that its failure threatened every bank on earth simultaneously. It began not with greed, but with genius. John Merriweather was Wall Street's most respected bond trader, a man who turned mathematical patterns into extraordinary profit. In 1994, Merriweather founded LTCM in Greenwich, Connecticut. He recruited not just traders, but two Nobel Prize-winning economists and a former Federal Reserve vice chairman. The fund's strategy was elegant. Find tiny price differences between similar bonds across global markets, then bet enormous sums those prices would converge. It worked brilliantly. In its first 2 years, LTCM returned 40% annually. Investors were euphoric. Banks lined up to lend. The fund grew to over $100 billion in assets. But the true scale of LTCM was hidden. Through leverage, borrowed money layered upon borrowed money, they controlled over $1 trillion in financial positions. For every $1 of real capital, LTCM borrowed 25. They were not just playing the market, they had become so large they were the market. The partners inside LTCM were so confident in their models that they invested their own fortunes. They believed they had not just beaten the market, they had transcended it. Their models were built on one core assumption, that markets, given enough time, always behave rationally, that extreme events follow predictable patterns. They were wrong. In August 1998, Russia shocked the world. It defaulted on its government debt and devalued the ruble, an event LTCM's models considered nearly mathematically impossible. Global investors panicked. They fled from risk, all risk, simultaneously. The price differences LTCM had bet would converge began exploding violently apart instead. In a single month, LTCM lost $1.9 billion, then another billion. Their models kept predicting recovery, the markets kept delivering devastation. Because LTCM was so leveraged, losses were amplified catastrophically. A 5% move in markets wiped out their entire capital base. The machine began consuming itself. By September 1998, LTCM had lost $4.6 billion. Their capital was nearly gone, but their $1 trillion position remained, still threatening every bank that had lent to them. The Federal Reserve of New York made an extraordinary decision. It convened an emergency meeting, summoning the heads of the world's largest banks to one room. 14 major banks were told the same truth. If LTCM collapsed in open bankruptcy, the chain reaction would potentially bring down the global financial system within days. The banks agreed to a $3.6 billion bailout, not from governments, but from Wall Street itself. LTCM was absorbed, the crisis was contained, but the lessons were eternal. LTCM was buried quietly. Its partners lost everything. The world moved on, but the architecture of the trap they built, leverage, certainty, complexity, was never dismantled. 10 years later, the same mechanisms, leverage, blind models, institutional overconfidence, produced 2008. The names changed, the trap did not. Today, funds larger than LTCM operate with similar leverage, models more complex, certainty more absolute. The lesson of 1998 sits in history books, rarely in boardrooms. So what can one person, protecting their own wealth, their own family's future, learn from the most decorated failure in financial history? Everything, starting here. Law 1. Never confuse a model with reality. A map is not the territory. A formula is not the market. Every model is built on assumptions, and assumptions eventually meet their exception. LTCM's models were built on 70 years of bond data. They believed this was sufficient. Russia's default was outside those 70 years. Reality has a longer memory than any dataset. The private investor's version of this trap is believing that because something has always worked in your lifetime, it will always work. Lifetimes are short, markets are ancient. Protect yourself from model risk. Stress test your assumptions. Ask not only what has happened, but what has never happened yet. The market will eventually show you. Law 2. Leverage is borrowed time, not borrowed strength. Every dollar you borrow to invest does not double your opportunity. It doubles the speed of your destruction if wrong. LTCM borrowed $25 for every $1 they owned. A 4% loss wiped them out entirely. Most private investors never calculate their own leverage ratio. They should, urgently. Leverage feels like genius during a bull market. Every gain is amplified. Confidence grows. The borrowed money feels like your own. This is precisely when the danger is greatest. The private investor's rule is if removing the borrowed money from your portfolio would cause you genuine anxiety, you are already overleveraged. Reduce before the market forces you to. Wealth preservation is not about maximizing returns. It is about surviving long enough to benefit from compounding. Leverage shortens your runway. Survival extends it indefinitely. Law 3. Complexity is not sophistication. It is camouflage. The more layers between you and understanding your own investment, the more layers between you and your money. LTCM strategies required Nobel Prize level mathematics to understand. Their investors trusted the credentials instead of demanding comprehension. Trust without understanding is not investing, it is hoping. If you cannot explain your investment strategy to yourself in 3 sentences, you do not own an investment. You own exposure to something you cannot control when it moves against you. The financial industry profits from complexity. Complexity justifies fees. It creates dependency. It obscures performance. The simpler your portfolio, the harder it is to deceive you. Simplicity is not a limitation of the unsophisticated investor. It is the chosen armor of the wise one. The greatest fortunes in history were built on strategies a child could understand. Law 4. Past performance is not just a poor predictor, it is an active seduction. The longer a strategy has worked, the more certain investors become. Certainty is where traps are hidden. LTCM delivered 40% annual returns for 4 consecutive years. Those returns did not prove the strategy was safe. They proved the conditions had been favorable. Conditions always change. The private investor's version, the fund that returned 20% last year, is the most dangerous place to put money next year. You are not buying future performance. You are buying last year's conditions. Before investing anywhere, ask one question. What specific conditions made this strategy work, and are those conditions still present today? If you cannot answer clearly, do not proceed. Performance chasing has destroyed more retirement wealth than any market crash in history. The crash is visible. The slow erosion of chasing yesterday's winners is invisible until it is too late. Law 5. When everyone is certain, be afraid. Consensus is not safety. In financial markets, consensus is the final stage before collapse. The crowd arriving is the signal to leave. Every major bank on Wall Street knew LTCM's positions. Many had copied them. When Russia defaulted, every institution tried to exit the same trades simultaneously. The exits had vanished. This is called liquidity risk. When markets are calm, everything is liquid. When panic arrives, liquidity disappears precisely when you need it most. This is not an anomaly, it is a law. The private investor's protection always hold assets that maintain value independently, assets that do not require a willing buyer in a panic to retain their worth. Gold, land, essentials. Contrarian thinking is not about being different for its own sake. It is about recognizing that when risk is universally dismissed, it has merely become invisible. Invisible risk is the deadliest kind. Law 6. Size is not strength. In financial systems, becoming too large, too connected, too integral does not protect you. It transforms you into a systemic risk that others must manage for you. LTCM believed its size gave it power. In reality, its size made it fragile. Every bank it owed money to became a potential trigger. Its connections were not a network of strength, but a web of mutual destruction. The private investor's lesson is the opposite. Stay small enough to move, stay simple enough to exit. The ability to disappear quietly from a bad position is a form of wealth most never value until they need it. Diversification is not about owning many things. It is about owning things that fail independently of each other. LTCM owned 1,000 positions, all of which collapsed for the same single reason. True diversification means asking, if the worst possible macro event occurred, a currency collapse, a war, a pandemic, which of my assets would survive independently? Build from that answer outward. Law 7. Brilliance is the most seductive credential and the least reliable protection. The smarter the person managing your money believes themselves to be, the more carefully you must watch them. LTCM had 2 Nobel laureates, a former Federal Reserve vice chairman, decades of combined Wall Street mastery. None of it provided protection when their core assumption proved false. Intelligence compounds overconfidence. The smarter a person, the more elaborate their justification for staying wrong. Genius does not eliminate blind spots, it decorates them with mathematics. When evaluating any fund manager, advisor, or investment platform, ask not what their best year looked like, ask what their worst year looked like, and ask whether they survived it on their own terms. The right advisor is not the most confident one in the room. It is the one who can articulate precisely how they could be wrong and show you exactly what they have done to prepare for that possibility. Law 8. Bailouts create the most dangerous moral hazard in financial history. When institutions learn that catastrophic failure brings rescue, they do not become more cautious, they become more reckless. LTCM was rescued because it was deemed too connected to fail. 10 years later, the same logic rescued banks in 2008. The private investor was not rescued either time. They paid for it through taxes, inflation, and lost savings. The bailout of LTCM sent a message through every trading floor on Earth. If you are large enough, connected enough, and dangerous enough, the system will save you. This message was heard and acted upon. The private investor has no such guarantee. No government will convene an emergency meeting to save your retirement portfolio. Your protection must be built before the crisis, not negotiated during it. The bailout moral hazard for private wealth. Never structure your financial life around the assumption that systems will remain stable or that authorities will intervene on your behalf. Plan as if they will not. Law 9. Patience is not passive. It is the most aggressive financial weapon available to the private investor and the one institutional funds are structurally incapable of wielding. LTCM collapsed because its borrowed money came with deadlines. Lenders demanded repayment. Positions had to be liquidated at the worst possible moment. Debt has no patience. Your own capital does. The investor who owes no one to no one can wait out any storm. They can hold quality assets through panic, through recession, through crisis, and emerge on the other side with everything intact. Institutional funds report quarterly. They answer to boards, to redemptions, to benchmarks. They cannot be patient even when they know they should be. This is your structural advantage. Use it deliberately. Build a financial life that requires nothing from the market in the short term. Income that covers needs, reserves that cover emergencies, and long-term assets that you can hold for decades without anxiety. Law 10. The ultimate purpose of wealth is not accumulation. It is freedom. Freedom from fear, freedom from dependency, freedom to make decisions based on values, not desperation. LTCM's partners were worth hundreds of millions and had zero freedom. Their positions owned them, their lenders controlled them, their models imprisoned them. Net worth without autonomy is a gilded cage. True financial freedom has a precise definition. It is the day your assets generate enough to cover your needs without you trading your time, your health, or your dignity to maintain them. This threshold is different for every person, but the path to it is universal. Eliminate debt, build income-producing assets, reduce complexity, increase patience. These are not theories, they are the only road. LTCM's partners spent years building extraordinary complexity and lost everything in weeks. The investor who builds quietly, simply, and patiently over decades loses nothing and outlasts everyone. There is a kind of wealth that has nothing to do with account balances. It is the wealth of sleeping without anxiety, of making decisions from strength, of never needing to be rescued by anyone. The men of LTCM were celebrated on every magazine cover, invited to every conference, consulted by governments. None of that translated into wisdom when the model met reality. Fame is not a financial strategy. The investors who preserved wealth across this era were not brilliant. They were disciplined. They held real assets. They avoided leverage. They ignored consensus. They were called boring until they weren't. Generational wealth is not capturing every opportunity. It is built surviving every crisis. The family that loses nothing across 3 generations accumulates more than the genius who wins then loses everything twice. The questions worth asking are not, how do I maximize this year's return? They are, what am I building that will still be standing in 30 years? What will my children inherit beyond money? They will inherit your principles, your relationship with risk, your definition of enough, your understanding of patience. These are the assets that compound most powerfully across generations and cannot be taxed. LTCM left behind a cautionary tale studied in business schools. The quiet investor who held gold, land, and debt-free assets through 1998 left behind something far more valuable, a family that was never afraid. History will always produce another LTCM, another genius, another perfect model, another certainty that unravels. The names change, the mechanism never does. Prepare accordingly every decade of your life. The market does not reward intelligence. It does not reward effort. It does not reward confidence. It rewards only one thing consistently: the investor who is still standing when others have fallen. So build simply, hold patiently, borrow never or rarely, and only what you can repay regardless of what markets do. Diversify genuinely, and always keep enough in reserve to think clearly under pressure. The greatest financial decision you will ever make is not which asset to buy. It is the decision to never allow fear or greed to override your principles. That decision, made once and held firmly, is worth more than any trade. Long-term capital management is gone. Its Nobel laureates are footnotes, but the investor who understood its lesson, who built quietly, held firmly, and slept soundly, is still here, still compounding, still free.